Welcome, everyone, to an incredible journey into the heart of Burkina Faso's economic transformation. In today's exclusive video, we're diving deep into the bold and groundbreaking reforms that are shaking things up under the leadership of President Ibrahim Traore. If you've ever wondered how a nation can break free from foreign control, boost local industries, and build an economy that's built to last, this is the place for you. Rocket. In Part 1, we're starting with some game-changing moves that are redefining the way Burkina Faso handles its finances. We'll explore how debt management is no longer about relying on foreign loans, but about creating a self-sustaining economy. We'll also take a look at the public sector salary reforms, where the government has set a powerful example by reducing the pay of high-ranking officials while empowering the everyday civil servant. And the big one, the nationalization of natural resources, particularly gold. Yes, you heard that right. President Traore's government is taking control of the country's vast gold reserves, ensuring that the wealth stays right here to fuel national development. So, if you're ready to see how Burkina Faso is transforming its economy and creating a future-proof nation, hit that like button, share this video with friends, and make sure you subscribe so you never miss out on these insights. We're not just talking about economics, we're talking about revolutionary change that could inspire nations all around the world. Let's dive into Part 1 and get into the details of how President Traore is reshaping Burkina Faso's future, one powerful reform at a time. 1. Debt management and financial independence. Under President Ibrahim Traore, debt management has been a crucial pillar of Burkina Faso's economic strategy. With the aim of achieving greater financial independence, Traore's administration took bold steps to reduce external financial reliance and prioritize domestic economic sustainability. Here's a detailed breakdown of this reform. Key aspects of debt management and financial independence. 1. Repayment of local debts. Debt reduction strategy. One of the first actions taken by the government was to pay off significant portions of the country's local debts. This move helped reduce the financial burden on the state and freed up resources that could be used for national development projects and social programs. Improved creditworthiness. By managing and reducing debt obligations, Burkina Faso aimed to improve its credit rating and increase its attractiveness to investors. 2. Rejection of IMF and World Bank loans. Avoiding foreign debt dependence. In a significant move to protect Burkina Faso's economic sovereignty, the government rejected loans from international financial institutions like the International Monetary Fund (IMF) and the World Bank. These institutions often impose strict conditions that could limit the country's economic freedom, such as austerity measures or demands for privatization of national assets. Focus on domestic financing. Traore's administration focused on building internal resources and financing mechanisms, such as tapping into the nation's natural resources, like gold, and increasing internal revenue generation through taxes and state-owned enterprises. Strengthened self-reliance. By rejecting foreign loans, Burkina Faso's government emphasized a commitment to self-reliance, prioritizing local solutions and indigenous resources over foreign dependence. 3. Reforming national financial institutions. Rebuilding local banks. The government strengthened national financial institutions, ensuring they could play a pivotal role in funding national projects without relying on foreign creditors. Reforms aimed at modernizing and making these institutions more efficient and capable of managing public finances. State-controlled resources. By nationalizing key industries, such as gold mining, the government could retain profits within the country, reducing the need for external borrowing and reinforcing financial sovereignty. 4. Increasing fiscal autonomy. Diversification of revenue sources. The government worked on diversifying revenue sources, moving away from overdependence on a single resource or external funding. By expanding sectors like agriculture, energy, and manufacturing, Burkina Faso was able to reduce its reliance on foreign loans and create a more resilient economy. Tax system overhaul. Efforts were made to improve the country's tax system, making it more robust and efficient. This included enforcing tax collection, reducing tax evasion, and ensuring that the revenues were directed toward national development goals. Reinvestment of local resources. The funds saved from reduced debt servicing were reinvested into key sectors such as infrastructure, education, and healthcare, strengthening the nation's internal economic capabilities. 5. National gold reserves. Gold is a financial asset. the government prioritized the creation of a national gold reserve, capitalizing on Burkina Faso's position as one of the top gold producers in Africa. This move was intended to use the country's natural wealth to bolster financial security and reduce vulnerability to global market fluctuations. Stabilizing currency. The gold reserves were also part of a strategy to stabilize the country's currency, helping to safeguard against inflation and economic shocks from external factors. Outcomes and impact. Economic sovereignty. Rejection of foreign loans and the focus on self-reliance enhanced the country's ability to make independent economic decisions without being beholden to foreign creditors. Reduced vulnerability. By limiting external debt, Burkina Faso became less vulnerable to the global financial system's volatility and the influence of international financial institutions. Increased domestic investment. As local debt was reduced and financial institutions were strengthened, more capital became available for domestic investment, especially in infrastructure, healthcare, and education. Public trust in financial system. The emphasis on managing local debts and creating financial stability helped restore public confidence in the country's fiscal management. In summary, President Traore's approach to debt management and financial independence focused on reducing reliance on foreign loans, improving the country's fiscal autonomy, and building a robust and self-sufficient financial system that could support sustainable growth for Burkina Faso in the long term. 2. Public sector salary reforms. Under President Ibrahim Traore, public sector salary reforms were central to his broader economic strategy aimed at promoting financial discipline, boosting public sector morale, and ensuring equitable distribution of national resources. By implementing changes to how government employees are compensated, Traore's administration sought to address both financial efficiency and social justice. These reforms have had notable impacts on the structure and dynamics of the public service in Burkina Faso. Key aspects of public sector salary reforms. 1. Reduction in salaries for ministers and parliamentarians. Pay cuts for elected officials. In a clear sign of commitment to austerity and national financial discipline, Traore's government reduced salaries for ministers and parliamentarians by 30%. This move was symbolic of the government's intent to set an example for the country, encouraging greater accountability and responsible spending in the public sector. Political message. The pay cuts were also a political statement, emphasizing the government's focus on serving the people rather than personal enrichment. It demonstrated a commitment to improving governance and aligning government salaries with the country's economic realities, which had been strained by ongoing security issues and financial limitations. 2. Increase in civil servant salaries. Salary increase for civil servants. While cuts were imposed on high-ranking government officials, civil servant salaries were raised by 50%. This move aimed to address the undercompensation of lower and middle-ranking government employees who play a critical role in delivering public services. Improving worker morale. The significant salary increase was intended to improve morale and reduce the incentive for skilled workers to leave the public sector in search of better-paying opportunities, especially in the face of challenging economic conditions. Attracting and retaining talent. The increase in civil servant salaries also aimed at attracting and retaining qualified personnel within critical sectors, such as education, healthcare, and public administration, ensuring that the public sector could perform effectively despite national challenges. 3. Public sector reforms to align with national priorities. Equitable pay distribution. The salary reforms were designed to be more equitable, ensuring that public sector employees were paid in accordance with their contribution to national development goals. The increase in civil servant salaries was especially focused on sectors crucial to public service delivery, such as healthcare workers, teachers, and law enforcement officers. Efficient use of public resources. By reducing the pay of higher-ranking government officials, the reforms aim to divert more resources into essential services, ensuring that a larger share of the national budget was used to benefit the wider public rather than political elites. 4. Focus on transparent and accountable government spending. Addressing public discontent. One of the motivations behind the salary reforms was to address growing public discontent over income inequality and perceptions of government inefficiency. By reducing the salaries of high-ranking officials, the government sought to reassure the public that it was committed to equity and the responsible use of state funds. Promoting accountability. The salary adjustments were part of a broader strategy to promote greater transparency and accountability within the government. By adjusting pay structures in a visible and impactful way, the government aimed to set a tone of fiscal responsibility across the entire public sector. 5. Ensuring public sector stability. Financial stability for public servants. The increase in civil servant salaries was also intended to ensure that public sector workers could sustain themselves and their families, reducing the risk of corruption, strikes, or unrest due to low wages. Reducing the brain drain. The salary increases helped reduce the brain drain, the tendency of skilled workers to leave Burkina Faso for better opportunities abroad, by making government jobs more competitive and rewarding. Outcomes and impact. Public sector morale. The salary reforms have helped improve morale in the public sector, with civil servants feeling more valued and motivated to contribute effectively to the nation's development. Increased productivity. The boost in salaries for public workers has been linked to improvements in productivity, particularly in sectors like education, healthcare, and public administration. Political will for change. By reducing the pay of elected officials while increasing salaries for civil servants, President Traore's government showed that it was serious about tackling income inequality and improving the living standards of ordinary citizens. Financial discipline and accountability. The government's focus on cutting salaries for high-ranking officials while increasing compensation for essential workers helped emphasize fiscal discipline and accountability. It demonstrated a commitment to ensuring that the public sector is not burdened with excessive administrative costs. The public sector salary reforms under President Traore represent a significant shift towards equity and financial discipline. By reducing the salaries of top officials while ensuring substantial increases for essential workers, the government has sought to align public sector compensation with national priorities and economic realities. These reforms not only boost morale but also serve as a symbol of the government's commitment to creating a fairer, more accountable, and productive public service, helping to build public trust and promote sustainable national development. 3. Nationalization of natural resources. Under President Ibrahim Traore, the nationalization of natural resources has been a central component of his economic reform agenda. Recognizing the immense value of the country's natural resources, especially gold, Traore's administration has worked to assert greater control over these assets to ensure that the benefits of these resources are retained within the country. The strategy also aligns with the broader objective of promoting economic sovereignty and reducing foreign dependence. Key aspects of nationalization of natural resources. 1. Nationalization of gold mines. Taking control of key gold assets. Burkina Faso is one of Africa's largest gold producers, with vast untapped gold reserves. Under Traore, the government took decisive steps to nationalize two of the country's major gold mines. This move was designed to ensure that the revenue from gold mining stayed within the country rather than being siphoned off by foreign-owned corporations. Economic benefits for the nation. By nationalizing these mines, the government ensured that profits from gold extraction would contribute directly to national development rather than being repatriated abroad. The move was aimed at using the wealth generated from gold to fund infrastructure, education, healthcare, and other national development goals. Job creation and local economic development. Nationalizing the mines also ensured that a larger share of the wealth generated would benefit local communities through the creation of jobs, investment in local infrastructure, and support for local businesses. 2. Creation of a national gold reserve. Strengthening financial security. To further consolidate control over the country's gold wealth, President Traore's government established a national gold reserve. This reserve serves as an economic buffer to help stabilize the country's finances, particularly in times of economic instability or external shocks. Reducing dependence on foreign reserves. By holding gold reserves within the country, Burkina Faso was able to reduce its reliance on foreign reserves or international markets to support its financial stability, thus promoting economic self-sufficiency. 3. Diversifying the use of natural resources. Reinvestment in local infrastructure. The government has reinvested the revenues from nationalized mines into infrastructure projects such as roads, bridges, and energy projects. These investments are essential for long-term national development, contributing to the economic growth of the country by creating a strong physical infrastructure base. Sustainable resource management. The nationalization of natural resources has also allowed the government to implement more sustainable practices. In resource management, ensuring that the exploitation of natural resources does not harm the environment or deplete these resources for future generations. 4. Reduced foreign influence in the resource sector. Limitations on foreign control. Prior to the nationalization, foreign companies had significant control over the extraction of gold and other resources in Burkina Faso. By nationalizing the mines, the government reduced the level of foreign influence in key sectors of the economy, ensuring that resource extraction was aligned with national interests rather than the profit motives of multinational corporations. Strengthening sovereignty. The nationalization of key resources is a move towards greater economic sovereignty, ensuring that the country has full control over its own natural wealth and can make decisions based on the long-term interests of its citizens rather than external pressures. 5. Increased transparency and accountability. Resource revenue management. With nationalized resources, there is a greater push for transparency in how the revenues from resource extraction are managed and distributed. The government introduced measures to ensure that the wealth generated from natural resources was not misused or diverted for corrupt purposes. Improving governance. Nationalization allowed for the creation of national bodies tasked with overseeing the proper management of natural resources, ensuring that the proceeds from these resources would be used for public good rather than benefiting a small group of elites. 6. Strengthening domestic industry and capacity. Local processing and value addition. Traore's administration emphasized the need to process resources locally rather than exporting raw materials. By nationalizing gold mining operations, the government can now focus on increasing the value-added component of gold extraction, such as refining and manufacturing gold-based products within Burkina Faso. Industrial development. The government also aimed to establish industries that can benefit from locally sourced gold, such as jewelry production and gold-based technology manufacturing, thus supporting the broader industrial development of the country. Outcomes and impact. Increased national revenue. The nationalization of gold mines has provided Burkina Faso with a more stable and substantial revenue stream. The profits that were previously lost to foreign corporations are now being reinvested into the country's development. Economic sovereignty. With control over its gold reserves and other resources, Burkina Faso is less vulnerable to global market fluctuations and the influence of foreign corporations. Job creation and local development. The nationalization process has created new employment opportunities, particularly in mining and related industries, which benefits local communities. Additionally, the government's reinvestment of resource revenue into infrastructure projects has contributed to regional development. Resource-based growth. By focusing on nationalizing natural resources and promoting local processing, Burkina Faso is laying the groundwork for sustainable, resource-based economic growth. Strengthened national identity. The move toward resource nationalization is also an assertion of Burkina Faso's national identity and independence. It reflects a desire to control and benefit from the nation's natural wealth rather than be at the mercy of foreign entities. Conclusion. The nationalization of natural resources under President Ibrahim Traore has been a landmark policy that aligns with the broader goals of economic independence and sovereignty. By taking control of the country's gold mines and creating a national gold reserve, the government has not only ensured that the wealth generated from natural resources stays within the country but also laid the foundation for sustainable economic development and local industrial growth. These actions reflect a long-term vision for Burkina Faso, aiming to reduce foreign dependency, promote transparency, and reinvest resource wealth into the country's development.